You're sitting at your computer checking your brokerage account for the third time this week, and you see it. Your quarterly dividend payment just hit your account. $15.37. You've been investing for 2 years, putting away $500 every month into dividend-paying stocks, and this is what you have to show for it. $15. You could make more money returning bottles to the recycling center. Sound familiar? Here's the thing most people don't understand about dividend investing. It feels painfully slow at the beginning because it is painfully slow. You're not doing anything wrong. The math just hasn't caught up to your effort yet. But what if I told you that there are 3 specific moments when everything changes? 3 tipping points where your dividend income doesn't just grow, it explodes. Where that measly $15 becomes hundreds, then thousands, then eventually replaces your entire paycheck. The average person gives up on dividend investing after a year or 2 because they can't see the exponential growth waiting around the corner. They think compound interest is some fantasy that only works for people who started investing in the 1980s. But the truth is, these tipping points are mathematically inevitable if you stick around long enough to see them. Think about it this way. You know how pushing a boulder up a hill feels impossible until you reach the peak? Then suddenly, gravity takes over and the boulder starts rolling faster than you ever could have pushed it. Dividend investing works exactly the same way. You're doing all the heavy lifting in the beginning, but eventually your money takes over and starts working harder than you do. Before we dive into the 3 tipping points, you need to understand the engine that makes all of this possible. It's not just about buying dividend stocks and collecting checks. That's only half the equation. The real magic happens when you reinvest those dividends. Instead of taking that $15 and spending it on coffee, you use it to buy more shares of the same stock. Those new shares generate their own dividends, which you reinvest to buy even more shares. It's like a snowball rolling downhill, picking up more snow with every rotation. Here's where most people mess this up. They see their dividend payments as free money to spend. But every dollar you spend instead of reinvest is a dollar that can't compound. That $15 dividend you spent on lunch could have turned into hundreds of dollars over the next decade if you just left it alone. Let's break down the math. Say you own 100 shares of a stock that pays a 4% dividend yield. If the stock is trading at $50 per share, your total investment is $5,000. That 4% dividend gives you $200 per year, or about $50 every quarter. Now, if you take that $50 and spend it, you'll get the same $50 next quarter. But if you reinvest it and buy one more share at $50, you now own 101 shares. Next quarter, you'll earn dividends on 101 shares instead of 100. It doesn't sound like much, but this is how compound interest gets its claws into your portfolio. The beauty of dividend reinvestment is that it's automatic. You don't have to time the market or pick the perfect moment to buy more shares. Every quarter, your dividends buy more shares at whatever the current price happens to be. Sometimes you'll buy high, sometimes you'll buy low, but over time, it all averages out. Most brokerages offer automatic dividend reinvestment programs called DRIPs that handle this for you. You don't even have to think about it. The dividends hit your account and immediately get converted into fractional shares. No fees, no hassle, no temptation to spend the money on something else. This is the foundation that makes the 3 tipping points possible. Without reinvestment, your dividend income stays flat forever. But with reinvestment, each payment becomes the seed for exponentially larger future payments. The first tipping point sneaks up on you. You won't see it coming because it happens gradually, then suddenly. It's the moment when your reinvested dividends start buying more shares than your monthly contributions. Let's say you're investing $500 every month in dividend-paying stocks with an average yield of 3.5%. In the beginning, that $500 monthly contribution is doing all the heavy lifting. Your quarterly dividends might be generating $30 or $40, which buys you a fraction of a share. Meanwhile, your $500 is buying 8 to 10 full shares depending on the stock price. But here's what most people miss. Those reinvested dividends are compounding on themselves. Every quarter, you own more shares. Every quarter, those additional shares generate more dividends. After about 3 years of consistent investing, something interesting starts to happen. Let's say your portfolio has grown to $25,000. At a 3.5% yield, you're now generating about $875 in annual dividends, or roughly $220 per quarter. If you're buying stocks at an average price of $40 per share, that quarterly dividend payment is now purchasing 5.5 shares automatically. Remember, you're still contributing your $500 per month, which buys about 12.5 shares monthly. But suddenly, your reinvested dividends are buying almost half as many shares as your contributions. You're no longer carrying the entire load. This is where the psychology starts to shift. You begin to see your portfolio as a living, breathing entity that's working alongside you instead of just a pile of money sitting there. Your dividends aren't just pocket change anymore. They're becoming a meaningful force in your wealth-building equation. By year 5, if you've been consistent, your portfolio might be worth $45,000. Now your annual dividends are around $1,575, or about $395 per quarter. At $40 per share, that's nearly 10 shares purchased automatically every quarter. Your dividends are now buying almost as many shares as your monthly $500 contribution. Then comes the crossover moment. Usually somewhere between year 6 and 8, depending on market performance and your contribution rate, your quarterly dividend reinvestment starts buying more shares than your monthly contributions. This is tipping point number 1. When this happens, your money officially starts working harder than you do. The majority of your portfolio's growth is no longer coming from your paycheck. It's coming from the dividends generated by shares you bought years ago with previous dividends. It's a beautiful self-sustaining cycle. Think about what this means psychologically. You could stop contributing new money entirely, and your portfolio would continue growing purely from dividend reinvestment. Obviously, you shouldn't stop contributing if you can help it, but knowing you could is incredibly powerful. This is also when you start to understand why dividend investing requires patience. Those first few years feel like you're getting nowhere because you are getting nowhere. You're building the foundation. You're accumulating enough shares to generate meaningful dividends. You're feeding the compounding machine until it's big enough to run on its own. Most people quit before they reach this first tipping point because they can't see the exponential growth curve that's coming. They look at their small dividend payments and think the strategy isn't working. But what they don't realize is that they're just 1 or 2 years away from the moment when their money starts to take over. Once you cross this threshold, everything changes. Your portfolio becomes less dependent on your contributions and more dependent on time and compound growth. The second tipping point is where dividend investing gets really interesting. It's when you discover that you're not just collecting static payments. You're building a portfolio of companies that actively increase your income every single year without you lifting a finger. Here's what most people don't understand about quality dividend stocks. The best ones don't just pay you the same amount forever. They raise their dividends annually. Companies like Coca-Cola, Johnson & Johnson, and Procter & Gamble have increased their dividend payments for over 25 consecutive years. Some have done it for over 60 years. Think about what this means. Let's say you bought 100 shares of a stock 5 years ago that was paying a $1 annual dividend per share. You were collecting $100 per year. But if that company has been raising its dividend by 5% annually, you're now collecting about $128 per year on those same 100 shares. That's a 28% increase in income from shares you bought half a decade ago. But here's where it gets wild. Remember all those shares you've been accumulating through dividend reinvestment? Every single one of those shares is also getting the dividend increase. If you now own 150 shares because of reinvestment, and the dividend has grown from $1 to $128, you're collecting $190 annually instead of the original $100. Your income has nearly doubled on that one stock. This is the dividend hike multiplier in action. It's compound interest on steroids because you're compounding both the number of shares and the dividend per share simultaneously. Most people only think about one side of this equation, but dividend growth investors get both. Let's walk through a real example. Say you started with a $10,000 investment in dividend growth stocks with an average yield of 3%. You're collecting $300 in year 1. But if those companies increase their dividends by an average of 6% per year and you reinvest everything, here's what happens. By year 5, your original $10,000 position might be worth $14,000 due to stock price appreciation. But more importantly, you now own significantly more shares through reinvestment, and each share is paying a much higher dividend. Instead of collecting $300 annually, you might be collecting $500 or $600 from that same initial investment. By year 10, that original $10,000 could be generating $1,200 or more in annual dividends. Your yield on your original investment isn't 3% anymore, it's 12%. This is called yield on cost, and it's one of the most powerful concepts in dividend investing. The psychological impact of hitting this second tipping point is enormous. You start to realize that you're not just building wealth. You're building a machine that pays you more money every year for the rest of your life. Even if you never add another dollar to your portfolio, your income will continue growing. This is when dividend investing stops feeling like a slow grind and starts feeling like magic. You check your account and see that your quarterly dividend payment increased by $50 compared to last quarter, not because you bought more stocks, but because 15 companies in your portfolio announced dividend increases. What's really powerful is that these dividend increases often exceed inflation. While the cost of living might go up by 3% per year, quality dividend growth companies often increase their payouts by 5% to 8% annually. Your purchasing power isn't just protected, it's growing. Once you understand this multiplier effect, you start looking at dividend stocks completely differently. You're not just buying shares. You're buying future income streams that will grow larger every year. That $50 stock paying a 3% dividend isn't just generating $150 annually. If it grows its dividend by 6% per year, it could be generating $250 annually within a decade. This second tipping point usually hits somewhere between years 7 and 12 of consistent dividend investing. It's when you realize that time isn't just your friend in dividend investing, it's your secret weapon. The longer you hold quality dividend growth stocks, the more powerful the multiplier effect becomes. Most people never experience this because they're constantly buying and selling, chasing the next hot stock or trying to time the market. But dividend growth investors who buy and hold get to watch this beautiful compounding effect unfold year after year. The third tipping point is the holy grail of dividend investing. It's when your dividend income becomes large enough to cover your living expenses. This is your freedom number, and once you hit it, everything changes. Most people think financial independence means having $1 million in the bank. But that's not how dividend investors think about it. We think about monthly cash flow. How much money is flowing into your account every quarter without you having to sell a single share? Let's say your monthly expenses are $4,000. That means you need $48,000 per year in dividend income to achieve true financial independence. If your portfolio has an average yield of 3.5%, you'd need about $1.37 million invested to generate that much annual income. Sounds like a lot, right? But here's what makes this achievable. You don't need to save $1.37 million out of your paycheck. Remember the first two tipping points? Your reinvested dividends and growing dividend payments are doing most of the heavy lifting by this stage. Let's trace the journey. Say you started investing $500 per month 15 years ago. Through consistent contributions, dividend reinvestment, and the power of dividend growth, your portfolio has grown to $800,000. At a 3.5% average yield, you're generating $28,000 annually in dividends. But here's where the math gets interesting. Those aren't static dividends. If the companies in your portfolio increase their dividends by an average of 6% per year, your $28,000 in annual income will become $37,500 in 5 years without you adding another penny. Meanwhile, if you're still contributing that $500 monthly, you're adding $6,000 per year to your portfolio. At current market prices, that might buy you shares generating an additional $210 in annual dividends. But those new shares will also benefit from future dividend increases. This is when the exponential growth curve really kicks in. Your portfolio might jump from $800,000 to $1.2 million in just 3 or 4 years. Not because the stock price has doubled, but because of the combined power of continued contributions, dividend reinvestment, and compound growth. Once you cross that freedom number threshold, something profound happens psychologically. You stop thinking about your job as a necessity and start thinking about it as a choice. You could walk away tomorrow and your lifestyle wouldn't change because your dividend income covers your expenses. But here's what's really wild. Most people who reach this point don't actually quit their jobs immediately. They keep working because they can, not because they have to. And since they're no longer dependent on their paychecks, they often negotiate better terms, take more risks, or pursue more fulfilling work. Your relationship with money completely transforms. Market volatility stops keeping you awake at night because you're not dependent on selling shares to fund your lifestyle. Your dividends keep coming regardless of whether the market is up or down. In fact, market downturns become opportunities to reinvest your dividends at lower prices. Think about the psychological freedom this creates. You never have to worry about layoffs, office politics, or toxic work environments again. Your portfolio is your boss now, and it's the most reliable boss you'll ever have. It shows up every quarter with your paycheck, and it gives you a raise every year. What's even more powerful is that this income stream is designed to last forever. Unlike a traditional retirement account where you gradually spend down your principal, dividend investing allows you to live off the income while preserving and even growing your capital. That $1.37 million portfolio generating $48,000 annually? In 10 years, those same companies will likely be paying you $75,000 or more annually due to dividend growth. Your purchasing power keeps increasing even in retirement. The timeline to reach this third tipping point varies dramatically based on your income, contribution rate, and market performance. Some aggressive savers reach it in their 30s. Others take until their 50s or 60s. But the beautiful thing about dividend investing is that time is always on your side. The companies in your portfolio are working 24/7 to grow their businesses and increase their dividend payments. You're essentially buying a piece of the global economy's profit machine. Every time someone buys a Coke, fills up at an Exxon station, or uses a Microsoft product, a tiny fraction of that profit eventually makes its way to your dividend account. This third tipping point isn't just about the money. It's about reclaiming control over your time and your life. It's about having the freedom to say no without consequences, and yes, without limitations. Now you might be thinking, this all sounds great, but 15 years feels like forever. Is there any way to speed this up? The answer is yes, but it requires some strategic thinking and probably some lifestyle adjustments. The most obvious accelerator is increasing your contribution rate. If you can bump your monthly investment from $500 to $750, you're not just adding 50% more capital. You're compressing your timeline significantly because compound interest works exponentially, not linearly. Here's the math. That extra $250 per month equals $3,000 annually. Over 15 years, that's $45,000 in additional contributions. But with dividend reinvestment and growth, that extra $45,000 could easily become $80,000 or more in your portfolio. And that $80,000 could be generating $2,800 annually in dividends by the time you reach financial independence. But increasing contributions isn't the only lever you can pull. Dividend yield selection matters enormously. If you can build a portfolio with an average yield of 4.5% instead of 3.5%, you need significantly less capital to reach your freedom number. Let's run those numbers. To generate $48,000 annually at a 4.5% yield, you need about $1.07 million instead of $1.37 million. That's a $300,000 difference. Depending on your contribution rate, that could shave 3 to 5 years off your timeline. But here's the catch. Higher yielding stocks often come with higher risks or lower dividend growth rates. You might get to your freedom number faster, but your income might not grow as quickly once you're there. It's a trade-off worth considering carefully. Another powerful accelerator is focusing on dividend growth rates. Companies that consistently increase their dividends by 8% to 10% annually instead of 5% to 6% can dramatically compress your timeline through the multiplier effect we discussed earlier. Think about it this way. If you own a stock that increases its dividend by 10% annually, it doubles its payout every 7 years. A stock growing its dividend by 5% annually takes 14 years to double. Over a 15-year investment horizon, that difference compounds into something massive. Geographic diversification can also accelerate your timeline. International dividend stocks, particularly in developed markets like Europe and Canada, often offer higher yields than U.S. stocks. Adding a 20% to 30% international allocation to your portfolio could boost your overall yield without significantly increasing risk. Real estate investment trusts, or REITs, are another accelerator worth considering. REITs are required by law to distribute at least 90% of their taxable income to shareholders, which typically results in yields of 4% to 8%. Adding REITs to your dividend portfolio can significantly increase your overall yield. But the biggest accelerator of all is probably lifestyle optimization. Every dollar you don't need to spend in retirement is a dollar less you need to generate in dividend income. If you can reduce your annual expenses from $48,000 to $36,000, your freedom number drops from $1.37 million to about $1 million at a 3.5% yield. This isn't about living like a monk. It's about being intentional with your spending. Maybe you downsize your house, pay off your mortgage, or move to a lower cost of living area. Maybe you optimize your transportation costs or find ways to reduce your healthcare expenses. The beautiful thing about dividend investing is that these accelerators compound on each other. If you increase your contributions, focus on higher yielding stocks, and reduce your target expenses, you could potentially cut your timeline in half. Some people reach financial independence through dividend investing in as little as 10 years by being aggressive with all these levers. They live well below their means, invest 40% to 50% of their income, and build portfolios with average yields of 4% or higher. But remember, there's a balance to strike. You don't want to sacrifice your entire 20s and 30s just to retire early. The goal is to build a sustainable system that allows you to enjoy life along the way while still making meaningful progress toward financial independence. If you want to make $10,000 a month with dividends as soon as possible, watch this next video.